The next topic is joint life policy. If a partner dies, a large sum of money may be payable to his representatives. The payment cannot be postponed. It may seriously affect the working of the firm. Therefore, many firms take out joint life policy. What is joint life policy? It is a policy which is decided by the partners of the firm on the joint lives of other partner. The purpose of joint life policy is to reduce the financial burden of the firm and at the time of payment of a large sum to the legal representatives of the deceased partner. The insurer receives the payout when after the death of his insured partner. There are different methods of accounting treatment. Okay. The insurer undertakes to pay a specified sum of money to any of the partner. For this, insurance company is paid annual premium. In that case, the amount received against the policy on the death of a partner can be used to settle the claim of the deceased partner. It should be noted that joint life policy will be an asset of the firm and the deceased partner has as much right to it as other partners. It is considered as a joint life policy is an asset, and so the deceased partner legal representative has got a right to get his share like other partners. Okay, it is a policy which is taken by the partners in the firm in order to reduce the financial burden of the firm at the time of lump sum payment to the legal representatives of the deceased partner. The firm pays premium on the joint life policy. The insurance company pays the amount of the joint life policy on the maturity of the policy or the death of a partner, whichever is earlier. Okay. So, they give either on the maturity of the policy or the death of the partner, whichever is earlier. Okay. Then, accounting treatment. When premium paid is treated as an expense, annual premium is paid to the insurance company for joint life policy by the partnership firm. That premium is treated as an expense. That is one of the accounting treatments. The premium is treated as an expense and debited to the profit and loss account. A joint life policy account is not maintained. Here, we don't maintain joint life policy. Firm doesn't maintain joint life policy account. When the policy matures, the amount received will be profit to be credited to the capital account of all the partners, including the deceased partner in the profit sharing ratio. So, they considered the premium as an expense and so it is debited to the P&L account. No joint life policy account, and when the policy matures, the amount received will be profit and that should be transferred to the partners, all the partners, including the deceased partners, capital account in their profit sharing ratio. This is the journal entry we have to pass if the firm treat the premium as an expense when premium is paid. Joint life policy premium account debtor to bank account, because it is an expense. The firm consider it as an expense and so it should be debited to bank account. At the end of the year, premium is transferred to P&L account. P&L account debtor to joint life policy premium account. The above two entries are repeated year after year. Year after year, they paid the premium account and premium amount and that is transferred to P&L account. But suddenly, if one partner die, what would be the entry? The insurance firm has to pay money to the firm. Okay. For that, we have to pass the journal entry like this. Bank account debtor to joint life policy account. The firm received lump sum from the or policy amount from the insurance company. When the amount received is distributed among the partners in their profit sharing ratio, joint policy account debtor to partners capital account. So, it should be distributed among the partners, all the partners in their profit sharing ratio. Then the second accounting treatment is premium treated as an asset, maintaining a joint life policy account at a surrender value. Under this method, it is recognized that joint life policy is an asset. This is because after payment for 2 years, a policy has a surrender value. the insurance company will be willing to pay a certain sum of money depending on the number of premium paid if the policy is surrendered to the insurance company. After 2 years, first year the surrender value is nil, then second year end it has its own surrender value. If we are not in a position to continue the insurance policy, we can surrender and we can get back some amount. They will not pay the full amount which we paid during the 2 years, but it has its own value. They will pay the lesser amount. That is why it is considered as, the premium is considered as an asset, okay, because it has its own surrender value. The policy has its own surrender value after 2 years. The premium paid or debited to joint life policy account, not to P&L account, because we consider it as an asset. We open joint life policy account. But the book value of the joint life policy is adjusted at the end of each year to its surrender value by transferring the difference book value and surrender value to P&L account. They compare every year book value of the insurance policy and the surrender value of the insurance policy. The difference amount should be transferred to P&L account. The joint life policy account will be shown in the balance sheet as an asset as this surrender value. When a partner dies, the amount receivable from the insurer is debited to bank account and credited to joint life policy account, which is then transferred to capital account of the partners in their profit sharing ratio. So the joint life policy is considered as an asset, and so it is shown in the balance sheet of the firm as its surrender value. If a partner dies, the insurance company pays the amount. That amount is debited to bank account and credited to joint life policy. Later on, the joint life policy amount is distributed among the partners in their profit sharing ratio. This is the way to treat the premium, treat the accounting treatment of the premium if it is considered as an asset. This is the journal entry for the above. On payment of premium, joint life policy account debtor to bank. At the end of the year, P&L account debtor to joint life policy account. Here we compare the book value with the surrender value. The difference between the book value and surrender value is transferred to P&L account. Then on the death of the partner, bank account debtor to joint life policy account. Then and transfer of balance in joint life policy account. Joint life policy account debtor to partner's capital account. So first entry is joint life policy account debtor to bank account. Second entry is we transfer every year the difference between the book value and surrender value. Then on the death of the partner, we received money. So bank account debtor to joint life policy account. Then we transfer that amount to partner's capital account. Third accounting treatment is when premium paid is treated as an asset and the reserve is maintained. Under this method, premium paid is debited to policy account and credited to bank account. Every year, an amount equal to the premium is debited to P&L appropriation account. The joint life policy account and joint life policy reserve account are mutually adjusted so as to leave a balance in each account equal to the surrender value of the policy. See, we created two accounts. One is a joint life policy account. Another one is joint life policy reserve account. Every year, the company, the partnership firm has to pay premium. That premium is debited to P&L appropriation account. The joint life policy account and joint life policy reserve account are mutually adjusted so as to leave a balance in each account equal to the surrender value of the policy. When the death occurs of a partner, the amount received is credited to joint life policy account. The amount standing to the credit of joint life policy reserve account is also transferred to it, and then it is closed by transfer to the capital account of all the partners, including the deceased partner, in the profit sharing ratio. So if death occurs, they get amount from the insurance company. That amount is credited to joint life policy account. In addition to that, the balance in the joint life policy reserve account is also transferred to joint life policy, and then they have to close the joint life policy account by way of transferring the amount which is in the joint life policy account to the capital account of all the partners, including the deceased partner, in the profit sharing ratio. This is the way to treat, if the company treat premium as an asset and if the firm maintains reserves also. This is the journal entry for the above treatment. On payment of a premium, joint life policy account debtor to bank account. At end of the year, P&L appropriation account debtor to joint life policy reserve account. Amount of premium is transferred to P&L joint life policy reserve account. Then the joint life policy reserve account debtor to joint life policy account. Here we compare book value and surrender value, and the difference amount is transferred to joint life policy account. On the death of a partner, bank account debtor to joint life policy account with the amount of policy. The firm receives money from the insurance company. Then the second entry is joint life policy reserve account debtor to joint life policy account. Amount in the credit of joint life policy reserve account. So we transfer the amount which is in the joint life policy reserve account to the joint life policy. Then we distribute the joint life policy account debtor, distribute the amount which is in the joint life policy to all the partners' capital account. So for that the entry is joint life policy account debtor, balance of life policy account to partners' capital account. This is the way to pass journal entries for the above treatment. This is a question for joint life policy. A, B, C are partners sharing profit and losses in the ratio of 2:2:1. On 1st January 2018, they took out a joint life policy of rupees 4 lakh. Annual premium is 20,000. Was payable on 1st January every year. Last premium was paid on 1st January 2021. B died on 1st March 2021 and the policy amount was received on 31st March 2021. The surrender value of policy as on 31st December each year were as follows. 2018 nil, because the first year is 2018. Usually the first year doesn't have any surrender value insurance policy. 2019 14,000, 2020 10,000. Show necessary account as on 31st December each year, assuming that number 1, the premium is charged every year to P&L account. Number 2, the premium is debited to joint life policy account and the balance of the joint life policy account is adjusted every year to its surrender value. Number 3, the premium is debited to joint life policy account and a sum equal to premium is debited to P&L appropriation account and credited to joint life policy reserve account. This is the question. Let's see how to solve this problem. This is the answer for the above question. Case number 1. In this case, the premium paid is charged to P&L account. They treat the premium as an expense and so it should be charged to P&L account. So nothing will appear in the joint life policy account of 2018, 2019 and 2020. But in 2021, the joint life policy account will appear as follows. Because 31st/3/21, bank 4 lakh rupees. 4 lakh rupees is the insurance policy amount. The partners died on 31st/3. Immediately, the insurance company paid the amount, policy amount. The firm received policy amount on 31st/3/2021. So, it distributed the policy amount to the partner's capital account in the profit sharing ratio. A 1,60,000, B 1,60,000 and C is a legal heir, may get the amount. Okay. This is the way to treat the policy amount in the case of case 1. This is case 2. They treat joint life policy as an asset and they open joint life policy account. Okay. On 1/1/18, they paid premium of rupees 20,000. On 31st/12/18, that is transferred to P&L account to 20,000. Then on 1/1/19, again they paid the premium of 20,000. Here, they compare that premium with the surrender value. The second year surrender value. First year there is no surrender value. Then second year 4,000 rupees, it is adjusted and the balance is transferred to P&L account, that is 16,000. Then this surrender value is the opening balance of the next year 1120, that is 4,000. Bank premium is 20,000. So totally 24,000. Out of that 24,000, surrender value is 10,000. The balance is 14,000. Then the next last year on 31st 3/21, the partners died. Okay. So to balance brought down, the surrender value is 10,000. And then the bank 31st 3 only he died. So the company paid the premium of rupees 20,000. Then on 31st 3/21, by bank account policy, their policy amount received, that is 4 lakh rupees, and then the balance is 4 lakh minus 30,000 is 3 lakh 70,000. 3 lakh 70,000 should be transferred to partners A, B and C in the ratio of 2:2:1. That is 1,48,000, 1,48,000 and 74,000. In this way, we have to treat the joint life policy account if they consider joint life policy as an asset and they adjust the surrender value. Okay. In this case, they compare book value with the surrender value. The balance, difference amount is transferred to P&L account. Okay. In the first case, there is no surrender value, and so the full amount is transferred to P&L account. In the second year, there is a surrender value of 4,000, and so they compare the book value with the surrender value. The balance is 16,000. That should be transferred to P&L account. In the third year, this is the balance, and then book value, that is the amount that is paid for premium is 20,000. 24,000 out of the total 24,000. Out of the 24,000, 10,000 is the surrender value, and so the balance is 14,000. That should be transferred to P&L account. This is the last year, because on 31st 3/21 he died, a partner died, and so the balance is 10,000 rupees. They paid as usual. They paid on 1/1/21, they paid the premium of 20,000, and they immediately on 31st 3 itself, the company receives the premium amount, that is 4 lakhs. If we deduct 4 lakh minus 30,000, we will get 3 lakh 70,000. That 3 lakh 70,000 should be transferred to A's capital, B's capital and C's capital in the ratio of 1,48,000, 1,48,000 and 74,000. In this case, they compare the book value with the surrender value. That is the unique feature of this case. This is the third case. First, we have to open joint life policy account. 1/1/18, they paid the premium of 20,000. That is transferred to joint life policy reserve account. That is 20,000. Second year also, they paid the premium on 1/1/19. That is 20,000. And the surrender value of second year is 4,000, and the balance amount is transferred to joint life policy reserve account. The third year, the opening balance is 4,000. Bank account is 20,000. Bank paid premium. The firm paid premium 20,000. Then the total is 24,000. Out of the 24,000, 10,000 is the surrender value. The balance is transferred to joint life policy reserve account. 1/1/21, balance is 10,000 rupees. Bank, the firm paid the premium 20,000. On 31st 3/21, the partner died, and the bank, the insurance company gives the policy amount, that is 4 lakh rupees, and then the partner's capital account is the joint life policy account. When we see the joint life policy reserve account, the reserve is 10,000. In the joint life policy, balance of joint life policy reserve is 10,000. So that should be credited here 10,000. So the total is 4 lakh 10,000. That 4 lakh 10,000 minus 30,000 is 3 lakh 80,000. That 3 lakh 80,000 should be transferred to A, B and C in the ratio of 1 lakh 52,000. in the ratio of 2:2:1. So A will get 1,52,000, B will get 1,52,000, and C will get 76,000. Now let's see how to prepare joint life policy reserve account. For payment of premium, the entry is joint life policy account debtor to bank account. At the end of the year, the P&L appropriation account should be debited and the joint life policy reserve account should be credited with the amount of premium. So, we have to debit P&L appropriation account. The entry is P&L appropriation account debtor to joint life policy account. So, here we have to write P&L appropriation account. The amount is 20,000. Then, we have to compare the book value and the surrender value of the policy. The book value and the surrender value. The book value is 20,000, surrender value is nil. So, the joint life policy reserve account debtor to joint life policy is 20,000. First year over. Then, second year, end of the year, the by P&L appropriation account for the payment of premium 20,000. Then we have to compare the book value with the surrender value. The surrender value is 4,000. So the excess surrender value should be debited to joint life policy reserve account and credited to joint life policy account. Joint life policy reserve account debtor to joint life policy. So 16,000 rupees. Then third year on 1/1/20, the balance is 4,000. Opening balance is 4,000. Then at the end of the year, the firm pays premium, that is 20,000. Then the surrender value of the policy is 10,000. Total is 24,000. This is book value. Surrender value is 10,000. The excess amount is 14,000. That should be debited to joint life policy reserve account and credited to joint life policy account. Okay. So 14,000 is, we have to write here excess amount of the surrender value. Then the last year on 31st/3/21 a partner died, and so the balance is how much? 10,000. Balance on 1/1/21 is 10,000 rupees. And during that period, the firm will not pay the amount because premium amount, because partner died on 31st/3/21 itself, and so they got the amount and they distributed the amount. So on 31st/3/21 we have to transfer the balance amount to the joint life policy account. So joint life policy reserve amount should be transferred to joint life policy. Okay. In this way, we have to prepare joint life policy reserve account.